Good morning, I'm Frank Fortunato. This is a live broadcast of CATEX-TV. Today is Monday, September 21st, 2009, the first day of fall. It's 11:30 a.m. Eastern Daylight Time in the U.S. It's 4:30 p.m. in London, 10:30 a.m. in Mexico City. If you need to reach us during the broadcast, you can phone in toll-free at 1-866-67-CATEX. Overseas, our AOL instant mail address is CATEX-TV. On this day in history, in 1938, a massive hurricane struck New England and New York. It cut Long Island in two. It caused 600 deaths and a significant amount of damage. And in 1999, only 10 years ago, a huge earthquake struck Taiwan, killing 2,400 people. We've got some news that came in after we put the issue to rest. It's being reliably reported now by several sources that Willis, the broker, is going to re-domicile to Ireland. Apparently, they're going to change their place of incorporation from Bermuda to Ireland. Joe Plumeri has said that the board of directors has determined that the company's re-domestication to Ireland is in the best interest of Willis and our shareholders. And the shareholders are going to vote at a meeting within the next few months. The move also requires the approval of the Supreme Court of Bermuda. Also in the news today is the former Swiss Re capital markets head, Al Celius, S-E-L-I-U-S, who is pretty well known, is going to head up a investment company called Securus Investment Partners, their New York office. He's going to be working on, guess what, development of Securus's activities in the U.S. with particular focus on product development of the existing asset management operations of the company. So that's some personnel moves, also some economic news. The U.S. recession is supposedly bottoming out. August's leading economic indicators were released by the Conference Board this morning. They said that the index of leading economic indicators rose 0.6% in August. This is the fifth straight increase. Apparently, many analysts had been expecting a 0.7% increase. Commentary says that these numbers are consistent with the view that after a very severe downturn, a recovery is very near. Stock market is unimpressed. It's down about 36 points. Now we'll go to our main news. We reported last week that the Association of British Insurers blasted the government's policies on UK insurance tax law as well. They've had an answer. The Chancellor of the Exchequer, Alistair Darling, it was reported over the weekend in the Mail on Sunday, will rewrite UK insurance law in the coming budget to preserve London's dominance and to stop companies from leaving the UK. Last week, the ABI produced a list of demands ahead of the pre-budget report. The Mail article yesterday says two of the ABI's major concerns on the taxation of foreign profits are likely to be met. To stop multinational UK firms from diverting profits to low tax jurisdictions, the Treasury treats with suspicion overseas units with large amounts of capital but little staff. Legitimate insurance subsidiaries are being caught in the tax net, according to the ABI. Yesterday's article says, by contrast, a British-owned manufacturing company would be allowed simply to pay the local tax and be exempt from UK taxes. The Association of British Insurers wants this exemption to apply to insurers. Well, apparently, Chancellor of the Exchequer, Darling, has heard that plea, and we'll see what he does. This is very interesting. Hampton Finer, who is the Deputy Superintendent of Insurance in New York, says regulators will this week discuss dropping Moody's from a list of acceptable ratings organizations. He said that concerns arose after the credit rating agency turned down an invitation to attend a regulatory hearing on Thursday where it was to be questioned about its ratings process. Deputy Superintendent Hampton says if we don't feel like we can get answers to our questions, the question is if we should put them on our acceptable rating organizations list at all. We're a little stunned. This is not going to be like a congressional hearing. No one's out to embarrass them. Moody's did not respond. Other firms approved by the NAIC to rate insurer-held securities, Fitch, S&P, and DBRS, have agreed to answer questions at the hearing on September 24th. The Insurance Day had a long article today about the cost of implementing the Solvency II regulation. Amy Tiernan, a writer for Insurance Day, wrote it. We'll quote from it. The cost of implementing Solvency II will be far beyond current estimates and could reach up to 100 million British pounds for large international insurers. This is according to Philip Smart, who is KPMG's head of Solvency II in the UK. He told Insurance Day that previous compliance cost estimates for the European Union-wide directive that were no more than £500,000 are unrealistic. The Solvency II directives will not only increase costs for the market in the short term, but commit insurers and reinsurers to long-term business overheads. The original intent, of course, of the Solvency II scheme was to harmonize regulatory requirements across Europe. Some people are quite upset. Stephen Hadrill, the executive director of the aforementioned Association of British Insurers, says, in the UK, the impact of Solvency II is close to requiring fresh equity capital equal to the industry's market capitalization, more than £50 billion. It's hard to see how such a massive recapitalization could be achieved. This huge overcapitalization would mean investment returns in insurance will fall, companies will exit the market, prices will rise, cover will reduce, and innovation will lessen. Well, that's a pretty dire prediction. However, Henry Keeling, the new CEO of Guy Carpenter, says that in fact insurers need to take advantage of the hidden revenue opportunities that Solvency II could present. Keeling said that even though the directive is complex and costly from a compliance view, it does present companies with a competitive compliance. He said, we've found a thorough and effective compliance program can actually free up capital that might otherwise be committed as a regulatory requirement. A strong compliance program ultimately results in a competitive advantage, said Mr. Keeling. Well, we'll see where this ends up. The stock market remains down about 35 points. We'll go to a word from our sponsors. Southern France was hit by violent rainstorms on Friday and Saturday. It caused extensive but fairly localized flood-related damage. Intense rainfall caused mudslides and overflowing of rivers in coastal areas across the entire southern half of France. It's going to take a few days to obtain the first estimates of the damage, but the French government has already indicated, quote, that a state of natural catastrophe would quickly be declared for the affected areas. Declaring that natural catastrophe state is a precondition for the country's state-backed natural indemnification plan to kick in. The Saint-Maxime seaside resort on the French Riviera suffered its worst flood in 50 years when a river rapidly overflowed after a massive amount of water came down from the surrounding mountains. 200 cars were flooded there. Near Marseille, a mudslide caused the regional train to derail before moving to the southeastern coast.